Welcome to another episode of Millennial Investing Explained. Here's today's question. Now, Ryan, we've talked a lot about raising money from the perspective of the entrepreneur and from the startup perspective, but you've also been on the other side. You've mentioned that a couple times. Let's dive into that a little bit deeper. Talk to us about your experience from the perspective of an investor in startups.
Yeah, it's a fun ride, and it's fun to come in at different stages of startups. I've come in early on. I've come in with ones that are generating some capital, ones that are doing, a later series raise, and each one brings so many different benefits and excitement. I think for me, I really like coming in on the ground floor, and I love being able to mentor when I have a chance to hopefully share some advice and say, hey, there's a huge pothole right there. You can't see it, but trust me, I saw it and I hit it and lost a tire in it. So don't do it. And so I love that. So I've invested through kind of a venture fund, an angel network, and then equity crowdfunding, actually. So those are kind of the three platforms through which I've invested, or three outlets. And each one has its own benefits. With a venture fund, you're not picking the deals, you're picking the fund. And so you have to trust the partners. You just have to agree with the philosophy of the fund. And then with equity crowdfunding, you're 100% in control. And I think one of the biggest things that you need to come up with on your own is, what is your investment philosophy? At first, anything that was shiny, I invested in, which was just about everything. And it might be only a little bit here or there, not massive checks. But the risk you run with that is you can't learn. I mean, if you have such a diverse portfolio and you haven't taken the time and you're just throwing a little bit of money everywhere, some might hit it, some might not. There's a great book by Jason Calacanis, who's a big angel investor, called Angel. And he talks about some great angel investment strategies. He's talking about writing bigger checks. But even if you don't have the means to invest $5,000 in 100 startups like he talks about, invest $500 in 10 startups. And take that $5,000 and do that via WeFunder or Seed Invest or Start Engine, any of those, and start figuring out what your portfolio is. Do you invest in entertainment? Do you invest in hospitality? What's your niche? And start investing. And that's the only way you're going to learn. And guess what? You're going to lose money. That's part of it. But hopefully you strategically lose money, and some of your investments also make all of that loss back and then some.
What does equity crowdfunding look like from the perspective of the investor? So I understand you're getting a percentage of the company, but do you have any say in the company? Do you get to involve yourself with the co-founders? Do you have meetings with them? What does that look like? What is your involvement?
So every company is a little different. And that's actually, there's no regulation on communication other than you have to put an announcement out at 50% of your raise, 100% of your raise, and yearly. That's it, which you're going to get that with just about any startup anyway. Every company has different involvement, and so it just depends on what you want and what you want that involvement to be.
So it sounds like it's really on a company-by-company basis. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.